Welcome to the latest webinar from Paperchase. Today we are joined by a very special guest, David Spungen of Corient Advisors. He is a wealth management advisor specialized in the restaurant industry. We're hosting this webinar series to help educate our clients, members of the industry in bettering their careers. And today we're going to be speaking specifically about bettering your financial position. We're going to start off with some introductions. Then we'll go through a preparedness checklist, right? Like what are the things that you need to do now to make sure you're in a good financial position? We'll jump into preparing for your exit. Is your business currently sound? Is it ready for the next step? The types of exits that you can take in the restaurant industry. We'll go into a quick public market comp, and then we'll discuss tax mitigation strategies. So without further ado, I'd like to introduce David and Dimitri. Go ahead.
Great. So, Dimitri, Caroline, and all your colleagues at Paperchase, thanks for asking me to join today. Really nice to be here. By way of background, as Caroline said, I'm a partner and a wealth advisor at Corient, which is a national wealth management partnership that we're currently advising about $185 billion in assets. We have 240 partners. And we have a focus within the firm of working with founders and entrepreneurs. And my particular focus and passion is working with founders in the food and beverage space. So that's hospitality, CPG, hospitality tech, and some related adjacent areas. I am a former, or I should say a failed chef who tried to make a career out of that. And for a number of reasons decided to change that path. But I love to cook. I'm passionate about food. And I have a huge amount of respect for the folks on this call who have taken that path, and however I can help them be successful and manage that success so they don't have to worry about it once they've put in all the hard work. I am highly motivated to do that. So really glad to be here today, and hope we can be helpful.
Thank you, David. And thank you to everyone who has joined the call. I'm Dmitry Khrushchev. If you happen to notice a bit of an accent during this webinar, I grew up in South Africa. And if you're wondering why a South African would be called Dmitry, it's because I was born in Bulgaria. And my American journey began when I got a tennis scholarship to play at Cal Poly in San Luis Obispo. I still am based in Los Angeles at our Paperchase office out of there. My career started in traditional finance. I was an equity research analyst, covering mainly tech companies and some restaurants. And then my hospitality finance career began about 7 years ago at Triple Enterprises, which was a Paperchase acquisition almost 2 years ago. I always worked in corp finance roles, fractional CFO services. And M&A advisory. I joined Paperchase about a year and a half ago, and I've been building out the division with Philip Gay, who has extensive experience in advisory, fractional CFO, being the ex-CFO of California Pizza Kitchen. And really what we work on is getting clients through the fundraising process, building best-in-class materials to prepare for both board level discussions, investor materials, prepping them for Series A all the way through to Series C fundraisers, exit processes, and just understanding their business better overall. And we'll touch on that in the middle of this webinar today. But I'll hand it back over to David to start the presentation.
So we're going to get into more of these details, but I think one of the challenges for founders who are deep in growing their businesses is they generally think, I'll dealing with the proceeds of the exit when that happens. I don't want to jinx it by focusing before then. But there are a number of things that kind of basics, foundational pieces of the puzzle that you want to start to get in place as you're getting closer to that point. You don't want to wait until that happens for a bunch of reasons. So there's a couple of things that we generally, help founders with In a lot of cases, folks that we meet with, they're married, they have kids, maybe they have a house, maybe they rent a house, they've already got some assets. And so in a lot of cases, they haven't put basic wills and trusts in place, sort of the cornerstone of an estate planning strategy. And even if you're not at the point of doing more advanced planning to mitigate gift tax and estate tax, it's a good idea to have that in place for a couple of reasons. Number one, when you have those documents in place, it keeps your estate out of probate, which it can be expensive and time consuming for someone who you've left that responsibility with. So it's good from that perspective. It's also good from the perspective that if something should happen to you and your spouse, if you're married, your wishes have been clearly laid out as opposed to going to a default process through probate. So that's a really important thing. We can go into more details of that, but fairly easy to go and put those documents in place. As part of that process, you generally want to put together powers of attorney, which basically say if anything happens to you, if you're incapacitated, if you can't make decisions for yourself, you appoint someone to take those decisions on for you. Obviously important, highly likely that's not going to happen, at least, not for many, many years. But if it should happen, you've got that in place. And then a healthcare proxy, which basically lays out your wishes should you be in a situation to be potentially resuscitated. You can put a DNR order in there, those kind of things. Again, difficult issues to think about, particularly if you're young and healthy, but just good things to get into place. So those all come as generally part of a package when you go to an estate planning attorney. Those are the basics that you want to get into place. The second thing that, at a point where even though you may not be think of yourself as being wealthy, and maybe it's on paper, not in your bank account or your investment account. But as the value of your business grows and you get closer to a transaction, those assets are potentially vulnerable to litigation and other threats. And so, we like to say, even if you don't think you're wealthy, the person who comes into your apartment to hang a picture, falls off a ladder, Googles you, sees that you're an owner of a restaurant group that owns 6 locations, they call a lawyer and they go after you. General liability insurance is typically referred to as umbrella insurance, which really covers those risks. So what you don't want to do is spend, years of time and energy and passion building a business, building wealth, and then have it potentially go out the window because you didn't have that protection. So for the most part, umbrella insurance is relatively inexpensive, depending on what your situation is, what your needs are. Call it $5 to $10 million of umbrella insurance would cost you anywhere from $1,000 to $2,500 a year. Not terribly expensive. Hopefully you never need it, but if you do, it's there and it would be really important. And we generally recommend that you work with a well-qualified insurance broker who can review your existing coverages. If you have homeowners, if you don't have a home that you own, there's renter's insurance, there's auto. And a lot of cases, what we see is those policies are set up without necessarily looking closely at the coverages and the exceptions. And it's really important that all those fit together, so there's no chinks in the armor, there's no holes in the coverage. So that's something that we recommend doing before you need it. So again, not hard to do, not expensive to do. There's also term life insurance. So life insurance is a whole different category. There's a lot of different situations, a lot of needs. It's not something you need to do or have to do. It really depends on the situation. But in a lot of cases, we work with founders who, have a path. Maybe it's a 5-year path to creating that liquidity or a 10-year path. And the risk that you face is for your family when you're thinking about, what that's all going to look like post an exit. If something happens to the founder, then the family's not going to necessarily be able to reap the benefits of that. And so by getting term life insurance where you're paying a relatively low cost, particularly if you're young and healthy, so that if, God forbid, something happens to you, your family will get whatever the number is, $1 million, $3 million, $5 million of life insurance proceeds, that would protect your family for the income loss and the potential, benefit of the sale proceeds. If you're not there and you're really the key person for that business, likely that, the assets that your family would get would be a lot less. So again, term life insurance is relatively inexpensive, relatively easy to get if you're young and healthy. If you have some health issues, that can be problematic, but that's something you work with an insurance broker on. And then the last thing, and this may or may not be relevant, it's probably not as relevant for most people, but there's something called second to die insurance. So that's life insurance, but unlike term, it's whole life. It's much more expensive. You pay a premium into a policy. A certain amount goes to pay for that, insuring against your passing, and the rest goes into an account and builds up over time. So the checks that you write there are much bigger. The scenario where this is important is, let's say that you have a growing fast casual business. You're going to do a partial transaction. You're going to take some money off the table, but you're going to roll the rest of your equity and a significant part of your wealth into the business going forward. And let's say there's going to be 5 or 10 years until that piece gets monetized. If something happened to you in the interim, to you and your spouse, if you're married, depending on what other planning you've done, you could have an estate tax liability. And what you don't want to have happen is that you have a taxable estate, you have a bill to pay to the government, but all you have is in a liquid business that you can't sell, or not, at least not without having a fire sale. Second to die insurance insures 2 lives, so you and your spouse. It's less expensive to insure 2 lives than 1. And it pays when the second of the couple passes away, where in this scenario, that's when you would need to pay the estate tax. So again, if you do planning, which we can talk about a little bit later, you may mitigate the need for that completely, but it's really to cover that scenario where you have an estate tax liability and a valuable but illiquid estate. So, and just to be clear, I don't sell insurance. That's not my role, but we work with our clients and their advisors on tax estate planning insurance. And, we work with folks that we've had a good experience with. So happy to share any of that for anyone who it's relevant to.
Okay, and just looking back to the financial element of the business, and taking the step towards an exit event, or thinking that your business is ready for going through a sales process or looking for that next phase of growth. This is just a refresh. We've had some webinars early in the year that you can always check on our website, or just email us to get access to those. So this is just a quick refresh on getting core things achieved before you begin that process to optimize valuation. Because all acquirers or investors, 7 most important metrics and operation guides that lead to a higher valuation, and just shows that your business is scalable. We'll show some multiples later on in a few minutes, but really everything he has on the page, it's really essential to have everything written down. If you're going to be doubling your location count, there's really going to be a big due diligence from a future investor on processes and how that's all written down to remove yourself from the business and from the training, and being able to double and triple your location count growth. Having the investment materials be best practice also helps just lay out a wider pool of investors, and create a competitive environment where you're showcasing both your qualitative side and then your financial side, and really being on top of your numbers. It helps a lot understand your business, number one, and shows confidence to future investors that you're really on top of your accounting, your financial reporting, and thinking deeper about your numbers. One that's really important as well, especially lately with all of the digital sales improvements across fine dining even, particularly in fast casual and QSR, is really understanding your customer base and how loyal your customer base is. Often in due diligence, there will be a test of the POS and then the loyalty systems. Even in fine dining or members clubs, we see CRMs being reviewed. So understanding your customer base as well heading into a process is important. High level metrics, I think everyone has experience probably on the webinar, so I won't drill too much into this, but these really help optimize valuation. So whatever you can do, if you are thinking about expansion, try raise from a point of strength, and really you want to be hitting these metrics to optimize that valuation. One over here that we'll put in the bottom right is the product fit. So understanding your customer base, like I said, is really important. So, depending on your concept, we do often see, the frequency of visits is important. So having at least like a 40 to 50% loyal base that is coming 5 to 10 visits a year, depending on your brand and your concept. Obviously, the lower the check average, the higher the frequency should be. So that would be a really powerful tool to show investors if you have that data. We help clients analyze that data with our FP&A services so that we can track that month to month and understand the loyal customer base churn and the new loyal customers. Really, we try to highlight some core exit events or cash flow events, better said, for your business. The classic example is really having about 5 to 10 locations, sometimes even earlier on, from 2 to 3 that are proven concepts, loyal customer base. You can already start to access growth equity, strategic hospitality groups, where you can dilute some equity and have a good partner to get you to the next phase of even a larger exit. Franchising is not necessarily a more passive role. It can be very intense in its own way, but it does allow for more rapid scale. Think Dave's Hot Chicken, how rapidly they were able to expand with a very proven concept, simple to replicate, in a way that is a way to improve cash flow and those margins. There's still a lot of work, a lot of litigation in there, but it is a way, once you have done all the hard work on 1 or 2 sites, to consider it. Fine dining licensing, of course, we've seen large license fees upfront for foreign growth models where you can monetize. Again, is work. It's not a fully exit, but it is starting to remove yourself and starting to have that brand power to have large license fee agreements with international groups. That's relatively more common in the fine dining space, but also in the fast casual, upscale casual space. Secondary fundraisers, perhaps for starting to be a bit more of a mature brand and you're just aiming to dilute your equity stake. Again, nothing new on the slide, just a refresh on which phase of the business you may be. And again, at Paperchase, we help analyze all of these, and we would help build your material so that you understand your what if questions. What if I do this one? What if I do that one? How does that affect my exit event strategy? We're here to help through the whole process. A quick update on market multiples, particularly after the Vegas conference as well, and a general market update of the restaurant industry. I think coming away from Vegas, I think we learned that there is an overall optimism with the new administration in place, with the hopes of deregulation, even removing tax from tips, and the overall climate, particularly lenders and sponsors are quite excited about, seeking out the top new growth companies that may come out of a more a higher appetite for risk heading into next year, where people are starting to open up new brands and there's a pathway to really scaling your brand as well. Here we're looking at some franchisor and company-owned multiples, which have really converged over the last year. So there's a lot of high-performing company-owned and franchisor entities. So we get asked this question a lot on what is my preferred growth strategy, and this data proves that it really does depend on execution and how heavily involved you want to be on company-owned versus franchisor. Looking at the public markets, we have a quick snapshot here showing the year-to-date return in the column here. We have a few newsletters as well highlighting kind of the Tech 7 has their powerhouse stocks, and the fast casual stocks have really done a great job over the last 12 months and perhaps are a template for other brands to replicate what they are focused on. And really it's unique offering, healthier food. That most of them are company owned as well. So that is generally what is gaining a lot more return. The product is better than perhaps other brands lower down in the year to date or in the other top 20 stocks. So we've really noticed that even fast casual brands in the lower location counts that are, utilizing strategies of these top 3 or 4 fast casual brands are also hitting the 15-20% EBITDA four walls, strong brand loyalty, strong digital presence, and just the more portable concept with quick throughput of traffic. Looking at some private market multiples just to show everyone on the webinar the discounts from the public ones. Of course, this is looking at casual dining in QSR just to highlight, but here we look at, it's roughly 3 times less on the discount. So quite a big discount in the private market from the public. And generally, first half of this year was a bit of a decline through interest rates, going up at the end of last year. So now we are seeing some recovery there in those multiples, particularly with the optimism into next year. And then finally, this is just to, take away for yourselves as well. Perhaps you all have this. This was published at RFDC as well, but we wanted to highlight it and kind of show the ranking of the leading QSR brands over here. And again, show the private market EV over EBITDA and kind of that trajectory and what's being rewarded versus what's not. But yeah, having said all that, I'll hand it back over to David.
Great. Thanks, Dimitri. It's really great data. Appreciate you guys pulling that together. I mentioned in my comments up front that you don't want to wait until a transaction happens to do some planning, again, depending on what's important to you. And depend on the scale of your transaction. Some of these may or may not be relevant, but what we find is most people, when they get to the point of wealth creation, do care about their assets that they've spent so much time and blood, sweat, and tears building, being impacted pretty materially through tax. We can talk a little bit about income tax, but a big focus for a lot of the work that we do pre-exit is on estate tax. So just to level set there, when you pass away, your assets are subject to a tax above a certain exemption amount, which today that exemption amount is $13.61 million per person, double that per couple, so almost $27 million. That number is indexed with inflation, so it goes up every year. You may have heard about concern about a sunset provision of the 2017 tax bill that raised those limits much higher, more than double than where they were previously. And the expectation was at the end of 2025, they would go back to where they were 10 years ago. With the election and the change of administration, the expectation is that those tax cuts and the provisions of that 2017 tax bill are going to get extended. So for the time being, subject to any other legislation, the exemption amount is 13.6 million per person, double that per couple. So what that means is, let's say, all goes really well and you end up exiting and, you're 40 years old, you live till 90, you have 50 years for those assets to grow. So let's say that you have $100 million when you pass, or the second of you and your spouse pass, you would have $100 million less that, call it $28 million. So $72 million that would be taxed at 40%. So you'd be paying upwards of $30 million. Your family would be paying upwards of $30 million to the government for that. Now, some people may look at that and say, well, my family's great. My kids have more than enough. I'm not charitably inclined. I'm not going to be here, so who cares? But I think most people don't say that, and they'd say, I'd rather direct the funds to my family or charity or whatever the case may be, as opposed to paying it all that much in tax. And so what you can do and where it's really relevant prior to an exit is you can move assets out of your estate, which is subject to estate tax, into one of a variety, and there's a lot of different ways you can do this, but a trust that would be its own entity, and where those assets going forward would not be subject to estate tax. So it's not only the value that you put in there today, but the value that grows over your life. All that growth is not subject to that 40% estate tax, whereas if you hadn't done that planning, it would be. And particularly when you're talking about, decent sized exits and founders who are relatively young and have, 50 or more years to go, the numbers get really, really big. And so what you would typically think about doing, and again, in a scenario where you're doing a secondary, you're taking some money off the table, but you're rolling your equity into an ongoing, ownership of the business. A lot of times, if the money that you get today is sufficient to really support your living expenses, being realistic about, if you had a little money in your pocket, maybe you'd, buy a second home, you do some other things that maybe you're not doing now, and you do the math on that. If you took the balance up to that, $13.6 million per person, double that per couple, and move that value of your stock in the ongoing business into a trust, then those assets would not be subject to any estate tax, either when there was a transaction and that investment got monetized, or when the proceeds were reinvested in a variety of investments in a portfolio and continues to grow. All that growth is out of your estate. The one aspect that makes that particularly powerful is that if you are, let's say at that point, you do your secondary, let's say you're a minority owner of the business at that point, because you've brought in a private equity partner who owns majority, you can actually, the value that you would be transferring and the amount of that exemption you would be using up can get discounted because you're a minority owner, so you technically don't have control, and the government will accept a discounted value for that in most cases. But also, if it's in a liquid, business, you don't have liquidity, it's not a public company, they will also allow discounts for that. So again, every situation is different, but typically discounts would be about a third for those two issues. And so you could actually transfer more than this 13.6 or double that for a couple in actual value, because you're able to transfer at a much lower valuation. So that's very sort of 30,000 foot view. There's a lot of nuance here. You need to get a good team. You need to get a good estate planning attorney. You really have to take some time to think about what life is going to look like post-transaction, what the pros and the cons are of doing this kind of strategy. But again, if it's important to you that, your estate doesn't end up paying something like $40 million in taxes down the road, some good, careful planning today can really mitigate that and allow you to maintain your, your lifestyle as you expect to have it going forward. As far as income tax, because a lot of people talk about income tax, it's there's not a ton you can do. One thing that people talk about is changing domicile. You're in New York, it's a high tax state, it's a high tax city. You can move to a low tax jurisdiction, Texas, Florida, obviously are popular ones. There is a challenge with that in that if the income from the business is sourced in New York State, as an example, if your restaurants are all located there, moving out of state isn't going to help. So just, you have to make sure you understand that if you're thinking about making a move. That's number one. Number two, you can't move out of New York and go to Florida 2 weeks before your transaction closes. New York State is pretty aggressive about collecting their taxes, and there's really a process and there's advisors that can help you in terms of how long you need before a transaction, the things you need to do, how much time you need to spend in a new domicile. So again, a lot there. So it's something to consider depending on the size of your transaction, but not necessarily the easiest thing to do. There's also, if you are charitably inclined, there are strategies that you can use to mitigate income tax on a transaction. If you're not charitably inclined, these things don't make sense. But one example, one thing we work with clients a lot on is that there is an entity called a donor advised fund. That's sort of like your own mini foundation, but you don't have to do any of the administrative work. So you can open up an account, you can transfer assets into that account, you can transfer appreciated assets that have an unrealized gain. You transfer that in, it's considered a charitable gift. You get a deduction for the amount of the gift. The entity, the donor advised fund, then sells that, let's say stock, let's say you had a bunch of Apple stock with a very low basis because you've held it for a long time. They sell it, they don't incur tax, and the money goes into an account for you to give away to qualified charities over whatever time frame you want. So in that case, you would have avoided paying the tax on selling the Apple stock. So instead of, let's say it was $1,000, instead of selling it, if you wanted to make a charitable gift, paying the tax on that, and then you'd only have, call it $700 to make that gift with, you now have the full $1,000 and you got a larger charitable deduction for doing that. One of the advantages of a donor advised fund over a private foundation is that you can actually donate, subject to approval of the donor advised fund, shares in your illiquid business into that donor advised fund. And it's a more complicated process. You have to work with the fund. A lot of the big, financial services firms like Fidelity and Vanguard have donor advised funds. There's a lot of community-based donor advised funds, but there's a number that, very often will accept an interest in your active private business subject to there being an LOI. So this is something you do closer to the time of the transaction. You actually want the valuation to be higher at that point because you're going to get a bigger deduction. In a lot of cases, they will put in a provision that if the transaction doesn't happen, they're able to put the interest back to you because they don't want to be stuck being an owner of an illiquid company over a long period of time. It's really just to have that transaction, happen. And then that interest turns to cash and that goes into your account for the donor advised fund. So again, if you're not charitably inclined, it's not, you're giving the money away. It'll be out of your pocket. But it does create a pocket that you can then use to make charitable gifts if that's something that's important to you going forward. So again, not for everyone, but for some people, that's a good strategy. And then last thing I'll mention is tax loss harvesting investment strategies. So one of the things we regularly employ in client portfolios for part of their equity investment is what's called tax loss harvesting. What that means is you really quantitatively build a portfolio that is likely to perform very similar to the S&P 500 as an example. So you don't own all 500 stocks, but quantitatively you build a portfolio of, call it 75 to 100 stocks that are going to track that portfolio plus or minus a very small margin. If a stock that you own in there, let's say you own Coke, and Coke drops in price because they announced earnings that were disappointing to investors, and the stock price falls below your cost, the manager will sell that stock and replace it with Pepsi. It's overly simplistic, but that's the idea. So you're ending up kind of from a quantitative point of view, from the point of view of tracking the market, it's going to perform the same, but you now have a tax loss that you can use to offset other gains. And those gains could be from the portfolio, could be from a sale of the business. Obviously, this is something that has to be implemented before the sale. But one of the things that we've included more recently is we work with a manager who's taken this strategy, which is fairly commonplace now, and taken it to a higher level. And without getting into too much detail, it sounds a little complicated, and it is, but it's not as complicated as it may seem at first blush. If you have assets in an account, you can, at a custodian like a Fidelity or a Schwab, you can borrow money against those assets and take that money and buy additional stocks. You can then short a basket of stocks that's equal in value to the stocks you just bought on the long side. Because the stocks on the short side tend to lose money over time, you have a much greater ability to tax loss harvest than you would with a typical 100% long portfolio. And because your longs and shorts, for the most part, offset each other, it's really designed to track the return of the equity market, but where the tax loss harvesting ability is many times greater than in sort of tax loss harvesting, 1.0. So think of this as tax loss harvesting 2.0. And if you know you're having a transaction in a year or two or three, or in that scenario where you're doing a secondary, so you now have a portfolio that you can invest, but maybe you have 3 or 5 years to go until the second part of the transaction where there's going to be a big capital gain. If you employ this strategy, you can generate something on the order of 4 to 5% a year of the principal value in long-term and short-term capital losses that can directly offset gains on the sale of the business. So the more time you have, the better. If you knew you were going to have a transaction, let's say in January of 2025, it's based on tax year. So if you deployed that strategy today, you would have a year's worth of tax losses to offset the gain that was going to happen in tax year 2025. If you had 2 or 3 years prior to that transaction, even more so. You can build up, multiples of that, and it can really make a difference to mitigate some of the income tax that you would otherwise pay. Again, you need to have an investable portfolio to do this with before that transaction happens. In a lot of cases, that's not going to happen. But in a case where you're doing a secondary rolling over equity, that's something that can be really effective to lower your tax bill when the second part of the transaction happens. One quick thing I just want to mention on the first points here in terms of doing these transfers into a trust. With the charitable gifts, that's going to happen close to the transaction. Part of the benefit of making these transfers well in advance of a transaction is that typically the closer you get to selling the business, the higher the valuation is going to be. You're continuing to grow the business, you're opening more stores, you're growing your EBITDA. And so as time goes by, the value is going to go up, and your ability to transfer those assets through that exemption window, you're going to be able to get less and less. So there's a little bit of a balancing act of, you don't really know what the outcome is going to be. You don't want to give away valuable assets into a trust necessarily. And again, giving it away is relative. It's to your family. And there's also forms of these trusts where you actually, each of a couple gives a trust or funds a trust for the other. That's called a slat. We can talk more about that. But the longer you wait, the closer you get to a transaction. If you have a signed LOA, you're not getting any discounts on that valuation, and the valuation is likely much higher than if you had done it 1 or 2 or 3 years before. So anyway, just quick overview, but this is the kind of work we tend to do with founders when there's visibility within the next, say, 1 to 5 years for a significant transaction.
Thank you so much, David and Dimitri, for walking us through that presentation. We're now going to open it up for Q&A. If you joined us a little bit late, just to remind you, we have David Spungen on the phone. He is a wealth advisor specialized in hospitality, and we have Dimitri from our corporate finance department at Paperchase. We're happy to answer any and all questions that you have related to these topics. You can go ahead and drop that in the chat, or you can raise your hand and I can unmute you. And we already have one question to be answered. Chef JJ asks, who can help form your estate? I hear it costs a lot to form.
So it sounds like the question is, you're the one building that estate, but in terms of doing the estate planning. So the answer is there's a number of sort of very, very low cost alternatives. There's one called Free Will, which allows you to execute these documents for free. So there's a very low cost. There's a number of online platforms that do that. And I would say it's probably not the best solution if you're going to be doing more sophisticated planning, but it's better than not having the wills and healthcare proxies and powers of attorney. So that's where you would start. Working with a qualified, experienced estate planning attorney, particularly if you're doing the more sophisticated planning, is going to cost more. So I would say for that basic package of basic wills, healthcare proxies, powers of attorney, depending on the firm that you use, it's going to be anywhere from $2,500 to $10,000. Again, if you're not doing a lot of putting in bells and whistles. And there are some firms that will do it on a flat fee basis. So absent, bringing up, work that needs to be done that's more complex, you sort of go in knowing what you're going to pay. And I know for a lot of founders, entrepreneurs, even though they're building value in the business, that's a lot of money. And it's just a question of when you get close enough to a transaction where you realize that by doing this, you could literally be saving millions of dollars over time. It's worth it, but I know it can be painful to pay that expense, but I'm happy offline if anybody wants to reach out in terms of, finding good attorneys to work with in the practice in the state where you live, that work with entrepreneurs.
Thanks, David. After the session, we're going to send out an email to everybody with the recording. Please feel free to pass that recording along to anybody that you know that could use help in this area. We'll also keep David CC'd on that email. So if you need to reach out to him, he'll be right there to assist you with any additional questions you have or any wealth management advising needs that you have. And I think that we will then go ahead and wrap that up unless there are any further questions. Thank you so much, everybody, for joining us today. We truly appreciate your time and are grateful for your attendance. And so we will talk to you soon, and we'll be following up via email. Thank you so much.